What's up, guys? It's John Fig, pace around the yard and talk about the Fed hour. So the plot thickens. I was getting this house. We thought that all was lost yesterday. We had two offers. One was at $895, so it's from $875, $895. We put in a $900, and then we had two offers come in crazy, right? One was at $950, one was at $980, and we're like, okay, we're done. The market went full cuckoo, and then. And then this morning, both deals fell through it at $950 and $980, and they're like, send me your best offer. And so they just keep pushing forward on this. And there's no coincidence that interest rates went up to 4.72% today for the 30-year fix. So from 3% to 4.72% in like 60 days. So just to put that in perspective, what that means, a $900,000 house, if you bought it when it was at like 2.7%, is $4,000 a month. And then literally today, that same loan would be $4,800. So that's a 20% increase in monthly payment for the same priced house. So that's not going to have an effect on the market. And so the interesting thing about that is what that means is if you look at 2018 and you kind of follow fact patterns, what's happening is it took 60 days for the buyer demand to dampen. And because what happens is we're herd animals. So you basically get to a place where people FOMO. They're like, oh my God, I need to lock rates now. And it goes up, 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 up. And then ultimately you kind of flush out that liquidity. So all the people that have like some extra cash, because like the average person that buys, like 80 to 90% of people, like they're right on the edge. You know, it's like we're all like normal people buying this stuff. And so, you know, they're pushing as hard as possible to get their highest offer. And it doesn't matter if it's commercial real estate or if it's residential. It's such a competitive market that everyone's pushing to the top of their range. So if all of a sudden in a 60-day period, payments are 20% higher, then you're either going to ask your boss for a 20% raise or you're going to drop out of the house. And that's what's happening. So really the thing to follow right now is just follow the next 60 days in the market. And really the key markers that I'm looking for is decreased buyer demand. And the second thing is I'm going to be looking for how many people drop out of contract. So that's going to be a really important thing that we all need to be looking for, because the more people that drop out of contract, that's really going to be an indicative marker for what's happening. And another thing that's interesting that happened today as well is Goldman Sachs put out a report, and Jay Powell talked yesterday, who runs the Fed, and essentially they just telegraphed two rate hikes of 50 basis points each. And what that means is that you're at 25 basis points now, and then on May 4th, they're probably going to move up 50 basis points to 0.75%, and then it's going to go up to 1.25 really over the next over the next 10, 12 weeks. So what that's going to mean is that everything is going to have a higher cost to it. Credit card rates are about to go up. The APRs on credit cards are going to go up. Margin borrowing rates, which is going to have substantial effects, because even though most people that are probably watching this are like, hey, John, well, I don't use margin, right? But like all the couch traders, which another fun fact is that 4% of the United States population has quit their jobs because they've made less than $50,000 in Bitcoin. And if that sounds fucking crazy to you guys, it's crazy to me too. It's so wild. And the last time this happened was 2008 and 1999. So, if we look at history and we look at those kind of things happening, it seems a little crazy, right? So, when you just look at those stories, it's kind of wild just to not be like, what's happening right now? Are we seeing this melt up right before it cracks? And you've got all the markers, right? Inflation's at 10%. You have companies that are literally shutting down working in Russia, which makes total sense with all the horrendous things happening over there. So that's going to cut corporate earnings, and everyone in the stock market is pricing in the best thing ever. They're pricing in, 25, 26 PE ratio and record profits, because companies are saying, hey, we got purchasing power. And they may be right now, right? Because people's bank accounts are doing well, the economy's popping. But then what happens is that ultimately the liquidity dries out. So when gas prices go up to $6 a gallon, and then all of a sudden everything shoots up in price and housing prices are up 20%, what do people start doing? They start decreasing their discretionary income. So they decide to not go get that $5 Frappuccino, or not to buy that pair of UGG boots. And it's just, that's the natural cycle. So we're about to watch some really interesting things happen. I think the Q1 results are going to be really wild in the stock market. They're going to be all over the place. And you're going to have a bunch of people like tampering or, kind of resetting expectations, saying it's going to be better because it was the supply chain or it's Russia or whatever. And then we're going to see what ultimately happens in the long run. So, these are kind of the things that I'm thinking about right now. I don't have all the answers. I'm really looking through all of the data, and I'm going to make those decisions as I see fit. But essentially what I think is going to happen is I think that you're going to have a ton of decreased demand in the housing market. The last kind of few people are going to get in. And then from there, you're going to have an increase in inventories for housing. You're going to keep on watching rates go up. It's ultimately going to crack the stock market. And I think that a really, really good example and something that you can get into is as rates keep increasing, buying multifamily real estate once it gets up there, because once the economy finally cracks and the stock market drops, it'll be a really good entry point for the stock market. It will also be a really good time for you to buy multifamily, because if you get a 7 cap that has a 5% interest rate, it's a 2% spread, then from there you can get and these are all tons of topics I'm just running through super fast, so just know that I'm going to be doing a lot of topics about these, and I'm going to bite size each one to kind of go through it. So if it goes over anyone's head, like I talk like crazy fast and I went through a ton of subjects, so just know I'm going to be talking about residential real estate, commercial multifamily, talk about the stock trades that I'm looking at, talking about the Fed rate and macroeconomics and what are the markers I'm looking for. So I'll break all of that stuff down in upcoming weeks, so stay tuned. And I think that commercial real estate, going back to it, is going to be a really good play, because if you can get a 7% cap at a 5% loan when it really peaks out, then when the economy cracks and then interest rates go down to 3% again, then from there you just refinance and you're going to have a 4% spread and you're going to crush. And so you can't time everything. It's going to be a tough one, but you really have to keep your eyes peeled for what's about to happen, because we are going to watch an inflection point happen in the market over the next 6 to 12 months. And you just kind of have to sit tight, don't get FOMO, watch the market, and get ready. So, pull some chips off the side. There's a lot of profits to be had out there, and there's going to be a ton of buying opportunities in the future. So if you guys disagree with me, hit me up in the comments. I want to know every reason why I'm wrong, because that helps me learn. I want to know every counterpoint, because that really helps me, because obviously confirmation bias exists for all of us, and it's important that I'm learning, and at the same time I'm going to continue to voice my opinion, and we can go from there. So just hit me in the comments, let me know what you guys think. Like, share, and comment. If you guys want to share with your friends, I'm going to do a ton more long form content and get away from the shorts, because the shorts are really the primer for me to kind of show what I'm talking about, learning principles and habits, and from there I'm really going to dive deep on investing. And I've been super excited about this for a while, and stay tuned, it's going to be fun. So I'll talk to all of you guys soon. Peace.